Imagine a world where geopolitical tensions and bumper harvests dramatically sway the prices of everyday essentials like fuel, metals, and your morning coffee. Welcome to the volatile dance of global commodities. Dive into this week's commodities feed, where we're breaking down the latest shifts in energy, metals, and agriculture. Oil prices took a tumble yesterday, with ICE Brent crude hitting lows not seen since late October. This dip happened even as Ukrainian forces continued their assaults on Russian energy infrastructure. Moscow, in response, has issued warnings about potentially targeting ships from nations backing Ukraine, especially following recent strikes on Russian vessels. This escalation heightens the stakes just as Russia and the US engage in talks about the Ukraine conflict. Russia reports that the discussions have been productive so far, but let's be real, the territorial disputes look set to be a major stumbling block. But here's where it gets controversial: is this a sign of thawing relations, or just a temporary lull in a broader power struggle? Many experts debate whether these talks will truly lead to peace or merely buy time for more escalations. Meanwhile, despite the flat price pressure, ICE Brent time spreads have stayed strong, showing a backwardation of 40 cents per barrel. For those new to this, backwardation means the near-term prices are higher than future ones, signaling tight supply now. These spreads have actually strengthened over the past month, which seems counterintuitive given expectations of a loosening oil market through Q4 and into early next year. And this is the part most people miss: how can spreads firm up when inventories are building? It's a puzzle that highlights the complex interplay between supply forecasts and market psychology. Adding to the bearish vibe, the American Petroleum Institute's latest data revealed a 2.48 million barrel rise in U.S. crude inventories, alongside increases in refined products like gasoline, up 3.1 million barrels, and distillates, up 2.88 million barrels. These builds could keep squeezing product margins, putting more downward pressure on prices. Stay tuned for the more detailed Energy Information Administration report dropping later today. It might offer more clarity. Shifting gears to natural gas in Europe, prices are also feeling the squeeze, with the Title Transfer Facility (TTF) benchmark dipping to an intraday low of just over €27.50 per megawatt hour, its lowest since April 2024. Softer than average weather this season is easing demand, and ramping up US LNG exports is adding extra downward force. Plus, European storage levels are depleting faster than usual, now sitting below 75% of the 5-year average and last year's 85% mark. This could spell trouble if winter turns chilly. Imagine colder snaps leading to a sudden spike in prices, catching unprepared households off guard. Over in metals, central banks are making headlines with a gold rush of sorts. October saw global institutions adding a net 53 tons to their gold reserves, a 36% jump from September and the biggest monthly haul since November 2024, per the World Gold Council. Year to date, they're up 254 tons, though that's slower than the last 3 years, perhaps because higher prices are curbing enthusiasm. Poland stands out as the top player, snagging 83 tons so far this year and adding 16 tons last month alone, boosting its reserves to 531 tons, 26% of the total. Brazil matched that October addition, hitting 16 tons for the second straight month and reaching 161 tons, 6% of reserves. China's central bank, a consistent buyer, has now added gold for 12 months in a row, up 0.9 tons to 2,304 tons. On the flip side, Russia was the only seller, offloading 3 tons. This trend raises eyebrows. Are central banks hedging against currency volatility or signaling distrust in traditional assets? It's a hot topic. Some say it's a smart diversification move, while critics argue it could hint at looming economic instability. Wrapping up, the London Metal Exchange's Commitment of Traders report shows speculators ramping up bullish bets on copper, with net longs jumping 3,560 lots to 68,412 for the week ending November 28. Aluminum saw similar enthusiasm, with net longs climbing 5,206 lots to 116,335. These positions suggest optimism for industrial demand, but with global uncertainties, it's anyone's guess how they'll play out. Finally, in agriculture, Robusta coffee prices kept sliding for a second day straight, dropping over 2.5%. The culprit? A stellar harvest outlook in Vietnam, where the Vietnam Coffee and Cocoa Association predicts a 10% year-on-year jump to 1.9 million tons for the 2025-26 season, the biggest in 4 years. Despite some heavy rains, good weather and attractive prices have spurred farmers to boost production. That said, more rain on the horizon might compromise bean quality. Exports are projected to grow 7% year-on-year to 1.6 million tons. It's fascinating how weather and farmer decisions can flip the script on a global staple. Could this glut lead to cheaper coffee for consumers, or will quality issues drive up premiums for premium blends? What do you think? Do you believe the US-Russia talks will bring lasting peace, or is this just diplomatic theater? Should central banks be piling into gold, or is it a risky bet? Share your views in the comments. We'd love to hear if you're bullish or bearish on these commodity twists. Content disclaimer. This publication has been prepared by ING solely for information purposes irrespective of a particular user's means, financial situation or investment objectives. The information does not constitute investment recommendation, and nor is it investment, legal or tax advice or an offer or solicitation to purchase or sell any financial instrument. Read more, https://think.ing.com/about/content-disclaimer.